So Shani, we're here to talk about all things HECS. Over 3 million Australians at the last count have some student debt outstanding. That's almost as many mortgages that are in Australia. How does HECS work? How do the repayments work? When will people have to start paying? And how does that change over time?
Sure. I think the best way to go through this is probably an example. So you go to university and you get something called a Commonwealth supported place. And that means that you do get a loan from the government to pay your student loans. Plus, sometimes you do have additional loans on top of that you can take out for textbooks, etc. And so what the HECS loan is something that accrues over the duration of your degree. And at the end of it, you'll have to pay it back. Now, paying it back will be determined by how much you earn, basically. So there's certain thresholds that you'll have to meet before you do make repayments. The more that you earn, which I think is similar to probably what you're going through now, the more that you do earn, you will have to pay a higher percentage of your pre-tax salary towards that loan. And so from every paycheck that you do have, you're going to have part of that taken for your HECS loan to pay that back.
Is it a good debt or is it a bad debt?
Yeah, I think investors love to classify and, people who hold debt love to classify it as good or bad debt. Classically what we think of as good debt are mortgages, anything that's attached to an asset we like to think of as good debt. And so HECS has been seen as this good debt that a lot of people have because it is something that allows them to really improve their human capital and get better jobs, get better salaries, be able to earn more. And so they see it as good debt. But what we're seeing is a lot of people are questioning this and questioning whether it is actually good debt because they're finding that it's really reducing their quality of life with the amount of time it's taken to pay it off and how much their wages are garnished by each and every pay cycle when they do have that sort of debt.
So the most common advice that you'll see on HECS is to pay it last, even if it is frustrating. Why is that?
Yeah, I would say that the classic line that a lot of people say is it's the best loan that you'll ever get. And that is because it is it has an indexation rate applied to it instead of an interest rate. And so an indexation rate is really connected to CPI. There are some proposed changes in terms of what it will be connected to, such as a wage price index. But realistically, you're never really going to get a loan that doesn't have an interest rate attached to it in the way that you have an indexation rate attached to a HECS loan.
You took a different route. Do you maybe want to talk about that a little bit?
Yeah, so I think, a lot of people try and avoid it and don't look at it. And I think there's some certain circumstances that you do have where you do want to pay off your HECS. And I was one of those people that would anxiously check their balance all the time and really wanted to pay it off. I saw how much it was garnishing my wage. We obviously have this structure where the more you earn, the more your wages will be garnished to pay off that HECS debt. And so I got to a point where I was earning a very good salary and I was having 10% garnished from my wages. And I had 2 financial years before I did pay off my balance. And the maths just worked out in a way where it really just worked out better to pay it off. So I say that because the indexation rate is applied on June 1st. And none of the contributions that you've made towards your HECS for that particular year are applied to that June 1st indexation amount. And that meant that I would have indexation applied, my balance would increase, and I would still have to pay, 3-4 months of my HECS in the next financial year as well. So what I really wanted to do was pay it off. So for one, I didn't get that indexation rate applied. And then two, I wouldn't have my wages garnished for a full financial year when I could really just pay it off, and I had the spare cash to do so.
Great. And I mean, another benefit that you often see about, paying off the HECS debt early is your borrowing capacity.
Mm-hmm.
So people who are perhaps looking to get into the housing market, trying to be approved for loans, how does it affect that?
Yeah, definitely. So, I mean, any money that you're not getting into your bank account because of your HECS loan is money that you're not able to spend on a mortgage. And so what a lot of mortgage brokers like to do is really just assess how much your capacity would increase if you are looking to purchase a house and take on a mortgage if you were to pay off your HECS debt, especially if you are in a dual income household and you both hold HECS. So they do like to do that. And again, I think, there's always this blanket advice that's given by financial professionals professionals, which is don't pay it off. It's the best loan you'll ever get. The indexation is great. You're never going to have an interest rate like you do on a personal loan or a credit card. And that's all well and good. But, personal finance is exactly that. It's personal and it's based on you and what you should do in your circumstances. If you're someone that's really anxious having debt and you're worrying about it all the time and it's something that you really don't want to think about anymore, just pay it off. It's not going to hurt you or hinder you. There are, of course, if you look at it from a logical standpoint, the opportunity cost is there in terms of other things that you could have done with that money. But if it's going to give you peace of mind, just do it.
I was listening to a podcast the other day where they described this kind of situation as something being optimal in a spreadsheet versus optimal for the actual human being. And I guess it's kind of similar to that.
Exactly it. And I think there's plenty of examples in personal finance that are the same. I would say children are a really great example. A lot of people, if they put it into a spreadsheet and they think, I really can't afford to have children and I shouldn't be having children, but they have this innate desire to have children, they make it work. And I think that's one example of it. The other is, of course, housing. And I think, housing by a lot of very standard measures, when you look at it, is completely overpriced. It's an overpriced asset in Australia, but it's not just a commodity, it's not just an asset, it's a home, it's somewhere for someone to be, it's financial security, but it's also emotional security. There are a lot of considerations with the purchases that we make and the debt that we have and what we do with our money that isn't just considering what's in a spreadsheet.
I think that's another potential advantage of paying off HECS early is that you talk about this cash flow. And it might make it easier for more obtainable for people to really move closer towards goals that they have. If, we've talked about in the past, in a few of our articles, having kind of a paycheck regime. Well, if you're not suddenly having to pay 10% towards HECS every month or every fortnight, that opens up a fresh 10% that can go towards another financial goal, for example.
Yes, I think there's two sides to this. I think, the first is looking at the logical opportunity cost. Again, what we talked about with the spreadsheets, which is what is the indexation rate that I am probably going to pay and what are the investment returns that I'm looking to get. And I think that can kind of help you work out what you would rather do. But I think, again, the other thing is if you want to pay off your HECS and it's going to make you feel better and have peace of mind to have that cash flow, then that's also something that a lot of people would like to have.
So obviously there are some advantages to paying off your HECS early, as we kind of covered today already. Are there other kinds of debt you should really look to eliminate first, though?
I think if you have any other debt, in general circumstances, you would just pay that off first. And there are a couple of reasons for this. The first is that most other forms of debt are based on that interest rate. So you will be paying more for that debt than you would be for that indexation rate based on your HECS debt. And the other is that the way that it compounds. And so when we're looking at interest rates, if you're looking at credit cards, personal loans, the way that it compounds will probably be on a daily basis or a monthly basis, depending on what you hold. And that's going to mean that you're going to be paying more interest on that particular debt, while with the HECS debt, it's indexed once a year, and that's on June 1st. So there are some advantages to obviously paying off your HECS early, but I would say generally, if you have any other debt, you would pay that off first.
This video has been prepared for clients of Morningstar Australasia Pty Ltd and or New Zealand wholesale clients of Morningstar Research Ltd. Any general advice has been provided without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.